Passing the health and life insurance exam requires a clear understanding of essential concepts, policy types, and regulatory rules. In this video, we'll cover core insurance principles, types of life and health policies, and regulations and consumer protections. And don't miss what's happening in the bottom corner. It's designed to supercharge your exam prep. We'll explain more in just a minute. Let's dive in and get started.
Let's start with a review of general insurance principles. Insurable interest, indemnity, and risk. What is the primary purpose of indemnity in insurance contracts? Is it A, to provide a profit to the insured? B, to restore the insured to their original financial position? C, to guarantee a payout regardless of loss? Or D, to ensure the insurer always benefits? The answer is B, to restore the insured to their original financial position. Indemnity ensures that the insured is restored to their financial position prior to the loss, preventing profit from the insurance claim. This principle is fundamental to maintaining fairness in insurance contracts. Which of the following is not a requirement for insurable interest in a life insurance policy? Is it A, existence at the time of policy inception? B, a financial or emotional loss upon death? C, existence at the time of claim? Or D, a legal relationship between the insured and policyholder? The answer is C, existence at the time of claim. Why this question may seem a bit tricky? The phrasing "not a requirement" can lead to confusion. Insurable interest must exist at the policy's inception, not necessarily at the time of claim.
Have you noticed the code in the bottom corner? Next time you're stumped, take that code to birdsy.ai for immediate help and a free study session with Birdsy, your personal AI study partner. Plus, you'll get access to hundreds of additional questions, helping you move closer to passing your exam with confidence. The next time you're feeling unsure or stuck, give it a try.
John's house was insured for $200,000, but the actual value was $150,000 at the time of loss. How much will the insurance company likely pay? Is it A, $150,000, B, $200,000, C, $175,000, or D, $0? The answer is A, $150,000. The principle of indemnity prevents overcompensation. John will receive the actual value of the house, $150,000, as insurance aims to restore the insured to their pre-loss financial position. What does insurable interest ensure in an insurance contract? Is it A, a legitimate interest in the insured item or person? B, guaranteed profit from the insurance policy? C, unlimited coverage for any loss? Or D, a fixed payout regardless of the loss? The answer is A, a legitimate interest in the insured item or person. Insurable interest ensures that the policyholder has a legitimate interest in the preservation of the insured item or person, preventing insurance from being used as a gambling tool. Sarah insures her car for $30,000, but after an accident, the repair costs are only $5,000. How much will she receive from her insurer? Is it A, $30,000, B, $5,000, C, $15,000, or D, $0? The answer is B, $5,000. Sarah will receive $5,000 as indemnity ensures she is compensated only for the actual loss incurred, not the full insured amount unless the loss equals or exceeds it. What is the principle of indemnity in insurance contracts designed to prevent? Is it A, overinsurance, B, profiting from a loss, C, underinsurance, or D, moral hazard? The answer is B, profiting from a loss. The principle of indemnity is designed to prevent the insured from profiting from a loss. It ensures that the compensation received is only enough to cover the actual loss incurred. Elements of a contract. What is the primary purpose of the offer in an insurance contract? Is it A, to finalize the contract terms, B, to propose terms for agreement, C, to provide insurance coverage, or D, to negotiate the premium? The answer is B, to propose terms for agreement. The offer in an insurance contract is the initial proposal made by one party to another, indicating a willingness to enter into a contract under specified terms. It is essential for establishing the terms of the agreement. Which of the following is not required for a valid insurance contract? Offer, acceptance, consideration, or a witness? Is it A, offer, B, acceptance, C, consideration, or D, a witness? The answer is D, a witness. Why this question may seem a bit tricky, the inclusion of witness might mislead test takers as it sounds like a legal requirement. A witness is not necessary for an insurance contract, unlike offer, acceptance, and consideration, which are essential elements. An insurance agent presents a policy to a client who verbally agrees to the terms. What element is still needed to form a valid contract? Is it A, offer, B, acceptance, C, consideration, or D, legal capacity? The answer is C, consideration. A verbal agreement indicates acceptance, but consideration, typically the payment of the premium, is still needed to finalize the contract. Without consideration, the contract is incomplete. In the context of insurance contracts, what does acceptance signify? Is it A, agreement to the offer terms, B, negotiation of contract terms, C, payment of the premium, or D, review of policy details? The answer is A, agreement to the offer terms. Acceptance in insurance contracts signifies the agreement of the offeree to the terms proposed by the offerer, forming a binding contract. It is a crucial step in the contract formation process. A client signs an insurance application and submits it with the first premium payment. What does this action represent in contract terms? Is it A, an offer to the insurer, B, acceptance of the policy, C, consideration for the contract, or D, a counteroffer to the insurer? The answer is A, an offer to the insurer. Submitting a signed application with payment represents an offer to the insurer. The insurer must accept this offer to form a binding contract. This step is crucial in the contract formation process. What is the role of consideration in an insurance contract? Is it A, it is the acceptance of the contract terms, B, it is the exchange of value between the parties, C, it is the offer made by the insurer, or D, it is the legal capacity of the parties involved? The answer is B, it is the exchange of value between the parties. Consideration in an insurance contract refers to the exchange of value between the parties involved. The insurer provides coverage while the insured pays a premium. This mutual exchange is essential for a valid contract.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsy.
Life insurance. Term, whole, universal, variable life products. What is the primary feature that distinguishes term life insurance from whole life insurance? Is it A, term life insurance provides coverage for a specific period, B, whole life insurance is generally cheaper than term life insurance, C, term life insurance accumulates cash value over time, or D, whole life insurance offers coverage for a specific period? The answer is A. Term life insurance provides coverage for a specific period. Term life insurance provides coverage for a specific period, whereas whole life insurance offers lifetime coverage. This fundamental difference affects the policy's duration and potential cash value accumulation. Which of the following is not a feature of universal life insurance? Is it A. Flexible premium payments, B. Adjustable death benefits, C. Cash value accumulation, or D. Guaranteed fixed interest rate on cash value? The answer is D. Guaranteed fixed interest rate on cash value. Why this question may seem a bit tricky. The question uses negative wording, which might confuse test takers. Universal life insurance offers flexible premiums and adjustable death benefits, but it does not guarantee a fixed interest rate on the cash value. Sarah, a 35-year-old, wants a life insurance policy that allows her to invest in stocks and bonds. Which type of policy should she consider? Is it A. Term life insurance, B. Whole life insurance, C. Variable life insurance, or D. Universal life insurance? The answer is C. Variable life insurance. Variable life insurance allows policyholders to invest in various accounts, including stocks and bonds, offering potential for higher returns but with increased risk. What is a key benefit of whole life insurance compared to term life insurance? Is it A. Lower premiums, B. Cash value accumulation, C. Coverage for a limited time, or D. No medical examination required? The answer is B. Cash value accumulation. Whole life insurance provides a cash value component that grows over time, offering both a death benefit and a savings element, unlike term life insurance. John is considering a life insurance policy that offers flexible premiums and the ability to adjust his death benefit. Which policy type should he choose? Is it A. Term life insurance, B. Universal life insurance, C. Whole life insurance, or D. Variable life insurance? The answer is B. Universal life insurance. Universal life insurance offers flexibility in premium payments and death benefit adjustments, making it suitable for John's needs. What is a defining feature of term life insurance? Is it A. Coverage for a specified period, B. Cash value accumulation, C. Flexible premium payments, or D. Investment options? The answer is A. Coverage for a specified period. Term life insurance provides coverage for a specified period, such as 10, 20, or 30 years, and pays out a death benefit only if the insured dies during the term. Policy provisions, options, riders. Which of the following is a standard provision in a life insurance policy? Is it A. Waiver of premium, B. Incontestability clause, C. Accidental death benefit, or D. Guaranteed insurability? The answer is B. Incontestability clause. The incontestability clause is a standard provision that prevents the insurer from voiding the policy after a specified period, typically 2 years, due to misstatements by the insured. Which of the following is not typically included in a life insurance policy's non-forfeiture options? Is it A. Extended term insurance, B. Reduced paid-up insurance, C. Cash surrender, or D. Waiver of premium? The answer is D. Waiver of premium. Why this question may seem a bit tricky. The options include terms that sound similar. Extended term insurance, reduced paid-up insurance, and cash surrender are standard non-forfeiture options. But waiver of premium is a rider, not a non-forfeiture option. A policyholder wants to ensure their life insurance policy remains active even if they become disabled and cannot pay premiums. Which rider should they consider adding? Is it A. Waiver of premium, B. Accidental death benefit. C. Guaranteed insurability. Or D. Cost of living adjustment. The answer is A. Waiver of premium. The waiver of premium rider allows the policy to remain in force without premium payments if the policyholder becomes disabled, ensuring continuous coverage. What is the primary purpose of the grace period provision in a life insurance policy? Is it A. to allow policy loans, B. to increase the death benefit, C. to prevent policy lapse, or D. to waive premiums? The answer is C. to prevent policy lapse. The grace period provision allows the policyholder extra time to pay a missed premium without losing coverage, typically 30 or 31 days. A client is concerned about inflation eroding the value of their life insurance policy's death benefit. Which rider should they consider to address this concern? Is it A. waiver of premium, B. accidental death benefit, C. guaranteed insurability, or D. cost of living adjustment? The answer is D. Cost of living adjustment. The cost of living adjustment rider increases the policy's death benefit in line with inflation, helping maintain its purchasing power over time. What is the primary function of the incontestability clause in a life insurance policy? Is it A. to allow policyholders to change beneficiaries, B. to prevent insurers from voiding the policy after a certain period, C. to ensure premiums remain level, or D. to allow policyholders to borrow against the policy? The answer is B. to prevent insurers from voiding the policy after a certain period. The incontestability clause prevents insurers from voiding a policy after a specified period, usually 2 years, due to misstatements by the insured. This protects policyholders from having their claims denied after this period.
Notice the code in the corner? When you're stumped by a question, enter it at birdsy.ai for immediate help. Enjoy complimentary study sessions and access to hundreds of additional questions to help you pass your exam with confidence.
Premiums, dividends, non-forfeiture. What is the primary purpose of a non-forfeiture option in a life insurance policy? Is it A. to increase the death benefit, B. to protect the policy's cash value, C. to lower premium payments, or D. to extend the policy term? The answer is B. to protect the policy's cash value. Non-forfeiture options ensure that policyholders do not lose their accumulated cash value if they stop paying premiums. This protects the investment made into the policy. Which of the following is not a non-forfeiture option available in life insurance policies? Is it A. extended term insurance, B. reduced paid-up insurance, C. dividends, or D. cash surrender value? The answer is C. dividends. Why this question may seem a bit tricky, the options include terms that sound similar. Extended term insurance, reduced paid-up insurance, and cash surrender value are non-forfeiture options. Dividends are not a non-forfeiture option. John has a whole life insurance policy and decides to stop paying premiums. What option allows him to keep the policy in force without paying further premiums? Is it A. cash surrender value, B. reduced paid-up insurance, C. extended term insurance, or D. dividend accumulation? The answer is B. reduced paid-up insurance. John can choose the reduced paid-up insurance option, which uses the policy's cash value to purchase a smaller, fully paid-up policy, keeping it in force without further premiums. How are dividends from a participating life insurance policy typically treated for tax purposes? Is it A. not taxable as income, B. taxable as ordinary income? C. Taxable as capital gains? Or D. Taxable only if reinvested? The answer is A. Not taxable as income. Dividends from a participating life insurance policy are generally considered a return of premium and are not taxable as income unless they exceed the total premiums paid. Sarah's life insurance policy has accumulated dividends. She wants to use them to reduce her premium payments. Which dividend option should she choose? Is it A. Cash payment? B. Dividend accumulation? C. Paid-up additions? Or D. Premium reduction? The answer is D. Premium reduction. Sarah should choose the premium reduction option, which applies dividends to reduce her premium payments, effectively lowering her out-of-pocket costs. What is the primary benefit of selecting the extended term insurance non-forfeiture option? Is it A. It increases the policy's cash value? B. It maintains the same death benefit without further premiums? C. It converts the policy to a whole life policy? Or D. It provides a loan against the policy? The answer is B. It maintains the same death benefit without further premiums. The extended term insurance option allows the policyholder to maintain the same death benefit without paying additional premiums, using the policy's cash value to purchase term insurance. Tax treatment and federal considerations. What is the tax treatment of life insurance death benefits received by beneficiaries? Is it A. They are generally tax-free? B. They are always subject to income tax? C. They are taxed only if the policyholder was under 65? Or D. They are taxed only if the policy was less than 10 years old? The answer is A. They are generally tax-free. Life insurance death benefits are generally received tax-free by beneficiaries. This is a key advantage of life insurance policies, providing financial support without additional tax burdens. Which of the following is not a taxable event related to life insurance policies? Is it A. Surrendering a policy for cash value? B. Taking a policy loan? C. Receiving dividends in cash? Or D. Selling a policy to a third party? The answer is B. Taking a policy loan. Why this question may seem a bit tricky. The use of not requires careful reading. Policy loans are not taxable events, unlike surrendering a policy or receiving dividends. John receives a life insurance policy payout after his father's passing. How is this payout treated for tax purposes? Is it A. It is taxed as ordinary income? B. It is subject to capital gains tax? C. It is generally tax-free? Or D. It is taxed if the policy was less than 5 years old? The answer is C. It is generally tax-free. Life insurance payouts received by beneficiaries are generally not subject to income tax, providing financial relief without additional tax obligations. Which statement about life insurance policy loans is incorrect? Is it A. Policy loans are not taxable? B. Interest on policy loans is charged? C. Unpaid loans reduce death benefits? Or D. Policy loans are always forgiven upon death? The answer is D. Policy loans are always forgiven upon death. Why this question may seem a bit tricky. The question asks for the incorrect statement, which requires careful consideration. Policy loans are not taxable, but unpaid loans can reduce death benefits. Maria is considering surrendering her life insurance policy for its cash value. What tax implications should she be aware of? Is it A. There are no tax implications? B. The cash value exceeding premiums paid is taxable? C. The entire cash value is taxable? Or D. It is taxed as a gift? The answer is B. The cash value exceeding premiums paid is taxable. Surrendering a life insurance policy can result in taxable income if the cash value exceeds the premiums paid, leading to potential tax liabilities. How are life insurance premiums generally treated for tax purposes? Is it A, they are tax deductible for individuals? B, they are not tax deductible for individuals? C, they are always tax deductible for businesses? Or D, they are taxed as income? The answer is B, they are not tax deductible for individuals. Life insurance premiums are generally not tax deductible for individuals. This is because they are considered personal expenses. However, there are exceptions for businesses under certain conditions.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsy.
Annuities and retirement planning. Fixed and variable annuities. What is a primary difference between fixed and variable annuities? Is it A, both offer guaranteed returns? B, fixed annuities offer guaranteed payouts while variable annuities do not? C, variable annuities are always safer than fixed annuities? Or D, both are affected equally by market fluctuations? The answer is B. Fixed annuities offer guaranteed payouts while variable annuities do not. Fixed annuities provide a guaranteed payout, while variable annuities offer payouts that can fluctuate based on investment performance. This fundamental difference affects the risk and potential return for the annuitant. Which of the following is not the feature of a fixed annuity? Is it A, guaranteed interest rate? B, predictable income stream? C, investment options? Or D, tax-deferred growth? The answer is C, investment options. Why this question may seem a bit tricky. The use of not can easily be overlooked. Fixed annuities do not offer investment options, which is a feature of variable annuities. Sarah is considering an annuity that offers potential growth tied to stock market performance. Which type of annuity is she likely considering? Is it A, fixed annuity? B, immediate annuity? C, deferred annuity? Or D, variable annuity? The answer is D, variable annuity. Sarah is likely considering a variable annuity, which allows for growth potential linked to stock market performance, unlike fixed annuities that provide guaranteed returns. Which statement about variable annuities is always true? Is it A, they involve investment risk? B, they guarantee a fixed return? C, they are tax-free? Or D, they provide a fixed income stream? The answer is A, they involve investment risk. Why this question may seem a bit tricky, the word always can mislead. Variable annuities always involve investment risk, unlike fixed annuities. John wants an annuity that provides a steady income without market risk. Which type of annuity should he choose? Is it A, fixed annuity? B, variable annuity? C, equity indexed annuity? Or D, immediate annuity? The answer is A, fixed annuity. John should choose a fixed annuity, which offers a steady income without exposure to market risk, unlike variable annuities. What is a key feature of a fixed annuity? Is it A, variable interest rate? B, market-linked returns? C, guaranteed rate of return? Or D, no tax deferral? The answer is C, guaranteed rate of return. Fixed annuities provide a guaranteed rate of return, making them a stable investment option. This feature distinguishes them from variable annuities, which have returns that fluctuate with market performance. Qualified plans, IRAs, distributions. What is the maximum annual contribution limit for a traditional IRA for individuals under age 50 in 2023? Is it A, $5,500, B, $6,500, C, $7,000, or D, $6,000? The answer is B, $6,500. For 2023, the maximum contribution limit for a traditional IRA for individuals under age 50 is $6,500. This limit is set by the IRS and may change annually. Which of the following is not a characteristic of a Roth IRA? Is it A, tax-free growth, B, tax-free withdrawals, C, no required minimum distributions, or D, tax-deductible contributions? The answer is D, tax-deductible contributions. Why this question may seem a bit tricky, the phrasing "not a characteristic" requires careful reading. Roth IRAs do not provide tax-deductible contributions unlike traditional IRAs. They offer tax-free growth and withdrawals. John, aged 60, wants to start withdrawing from his 401k. What is the earliest age he can do so without incurring a penalty? Is it A, 59 and a half, B, 62, C, 65, or D, 70 and one half? The answer is A, 59 and a half. At age 59 and a half, individuals can begin withdrawing from their 401k without incurring a 10% early withdrawal penalty. John is 60, so he can withdraw without penalty. Which of the following statements about 401k plans is always true? Is it A, employers must match employee contributions, B, employees can withdraw funds anytime without penalty, C, contributions are tax-deferred, or D, employees must contribute a minimum of 5%? The answer is C, contributions are tax-deferred. Why this question may seem a bit tricky. The use of always true can mislead. Employer matching is common, but not guaranteed. Contributions are tax-deferred, which is always true. Lisa, aged 45, is considering converting her traditional IRA to a Roth IRA. What is a key tax implication she should consider? Is it A, no taxes are due at conversion, B, taxes are due on the converted amount, C, future withdrawals will be taxed, or D, she must be 59 and a half to convert? The answer is B, taxes are due on the converted amount. Converting a traditional IRA to a Roth IRA requires paying taxes on the converted amount. This is a significant consideration for Lisa. What is the penalty for withdrawing funds from a traditional IRA before age 59 and a half? Is it A, no penalty, B, 10% penalty, C, 15% penalty, or D, 20% penalty? The answer is B, 10% penalty. Withdrawals from a traditional IRA before age 59 and a half typically incur a 10% penalty, in addition to ordinary income tax. This rule encourages saving for retirement by discouraging early withdrawals. Accident and health insurance, disability income, and major medical products. What is the primary purpose of disability income insurance? Is it A, to replace lost income due to disability, B, to cover medical expenses, C, to pay for long-term care services, or D, to provide a death benefit? The answer is A, to replace lost income due to disability. Disability income insurance is designed to replace a portion of the insured's income if they become unable to work due to a disability. It helps maintain financial stability during periods of disability. Which of the following is not typically covered by major medical insurance? Is it A, hospital stays, B, surgical procedures? C. Elective cosmetic procedures? Or D. Prescription medications? The answer is C. Elective cosmetic procedures. Why this question may seem a bit tricky. The use of not can easily be overlooked, leading to a misunderstanding of the question. Major medical insurance usually covers hospital stays and surgeries, but elective cosmetic procedures are not typically covered. John, a self-employed graphic designer, is considering disability income insurance. What should he prioritize when selecting a policy? Is it A, the premium cost, B, the benefit period, C, the insurer's reputation, or D, the waiting period? The answer is B, the benefit period. John should prioritize the benefit period to ensure he receives income replacement for as long as he might be unable to work. This is crucial for self-employed individuals who lack employer-provided benefits. Which statement about disability income insurance is always true? Is it A, it covers all medical expenses, B, it provides a full salary replacement, C, it is only available through employers, or D, it replaces a portion of lost income? The answer is D, it replaces a portion of lost income. Why this question may seem a bit tricky. The use of always can mislead test takers into thinking all options are correct. Disability income insurance is designed to replace a portion of income, not cover all expenses. Lisa, a marketing manager, is reviewing her major medical insurance policy. What should she check to understand her out-of-pocket costs? Is it A, the policy's premium, B, the policy's coverage limits, C, the deductible and co-payment, or D, the network of providers? The answer is C, the deductible and co-payment. Lisa should check the deductible and co-payment details to understand her out-of-pocket costs. These elements directly affect how much she will pay when accessing medical services. What is the elimination period in a disability income insurance policy? Is it A, the period during which benefits are paid, B, the waiting period before benefits are paid, C, the time after benefits end, or D, the period when premiums are waived? The answer is B, the waiting period before benefits are paid. The elimination period is the time between the onset of a disability and when benefits begin. It acts as a deductible in time rather than money. Managed care, HMOs, PPOs. What is the primary difference between an HMO and a PPO? Is it A, HMOs are more expensive than PPOs, B, HMOs require referrals for specialists, while PPOs do not, C, PPOs have a more limited network than HMOs, or D, HMOs and PPOs have the same network requirements? The answer is B, HMOs require referrals for specialists, while PPOs do not. HMOs require members to use a network of doctors and get referrals for specialists, while PPOs offer more flexibility in choosing healthcare providers without needing referrals. Which of the following is not a characteristic of a PPO plan? Is it A, flexibility in choosing healthcare providers, B, higher premiums compared to HMOs, C, requirement for referrals to see specialists, or D, coverage for out-of-network care? The answer is C, requirement for referrals to see specialists. Why this question may seem a bit tricky. The phrasing "not a characteristic" requires careful reading. PPOs do not require referrals for specialists, unlike HMOs, which is a key distinction. A patient with a PPO plan visits an out-of-network specialist without a referral. What is likely to happen regarding their insurance coverage? Is it A, the visit is covered, but with higher out-of-pocket costs, B, the visit is fully covered as if it were in-network, C, the visit is not covered at all, Or D, the visit requires a referral to be covered? The answer is A, the visit is covered, but with higher out-of-pocket costs. PPO plans generally cover out-of-network visits, but the patient will likely face higher out-of-pocket costs compared to in-network visits. What does the term capitation refer to in managed care? Is it A, a fee-for-service payment model, B, a type of insurance premium, C, a deductible payment method, or D, a fixed payment per patient to a provider? The answer is D, a fixed payment per patient to a provider. Capitation is a payment arrangement where a physician or group is paid a set amount for each enrolled person assigned to them, per period of time, regardless of whether that person seeks care. A new HMO member is confused about needing a referral to see a specialist. What should you explain to them? Is it A, referrals are optional for specialist visits, B, referrals are required to ensure coordinated care, C, specialists can be seen without any prior approval, or D, referrals are only needed for out-of-network specialists? The answer is B, referrals are required to ensure coordinated care. In an HMO, members must obtain a referral from their primary care physician to see a specialist, ensuring coordinated care within the network. What is a common feature of health maintenance organizations? Is it A, members can see any specialist without a referral, B, members must select a primary care physician, C, members have no network restrictions, or D, members pay higher premiums for more flexibility? The answer is B, members must select a primary care physician. HMOs typically require members to choose a primary care physician who coordinates their care and provides referrals to specialists. This is a key feature distinguishing HMOs from other plans.
Don't forget to comment below with your tips, challenges, and thoughts on exam preparation. Your experiences can make a big difference for others.
Policy provisions, renewability, exclusions. What is the primary purpose of the incontestability clause in a health insurance policy? Is it A, to allow insurers to cancel policies at any time, B, to protect policyholders from having their policies voided after a certain period, C, to ensure premiums remain constant, or D, to allow policyholders to change beneficiaries freely? The answer is B, to protect policyholders from having their policies voided after a certain period. The incontestability clause prevents insurers from voiding a policy due to misstatements after a certain period, typically 2 years, ensuring policyholder protection. Which of the following is not typically excluded from health insurance coverage? Is it A, cosmetic surgery, B, experimental treatments, C, routine checkups, or D, injuries from illegal acts? The answer is C, routine checkups. Why this question may seem a bit tricky. The use of not can easily be overlooked, leading to confusion. Routine checkups are generally covered, unlike cosmetic surgery, experimental treatments, and injuries from illegal acts. A policyholder with a guaranteed renewable health insurance policy is concerned about premium increases. What can the insurer do regarding premiums? Is it A, increase premiums for this policyholder only, B, never increase premiums under any circumstances, C, increase premiums only if the policyholder files a claim, or D, increase premiums for all policyholders in the same class? The answer is D, increase premiums for all policyholders in the same class. In a guaranteed renewable policy, insurers can increase premiums but must apply changes to all similar policyholders, not individually. What does the term non-cancelable mean in a health insurance policy? Is it A, the insurer cannot cancel the policy or increase premiums as long as premiums are paid, B. The policyholder can cancel the policy at any time without penalty. C. The insurer can cancel the policy only after the first year. Or D. The policyholder cannot change the coverage options. The answer is A. The insurer cannot cancel the policy or increase premiums as long as premiums are paid. A non-cancelable policy ensures that the insurer cannot cancel the policy or increase premiums as long as premiums are paid on time. If a policyholder's health insurance policy is conditionally renewable, under what circumstances can the insurer refuse to renew it? Is it A. If the policyholder files too many claims? B. If the policyholder changes employment status? C. If the policyholder reaches a certain age? Or D. If the policyholder moves to a different state? The answer is B. If the policyholder changes employment status. Conditionally renewable policies allow insurers to refuse renewal only under specific conditions, such as changes in the policyholder's employment status. What is the primary purpose of the grace period provision in a health insurance policy? Is it A. To allow policyholders to change their coverage options? B. To provide extra time for premium payment after the due date? C. To enable policyholders to cancel their policy without penalty? Or D. To allow insurers to increase premiums without notice? The answer is B. To provide extra time for premium payment after the due date. The grace period allows policyholders extra time to pay their premium after the due date without losing coverage. This provision ensures continuity of coverage despite temporary financial difficulties. Group versus individual, underwriting, tax issues. What is one key difference between group and individual health insurance underwriting? Is it A. Group insurance requires individual health assessments? B. Individual insurance evaluates each applicant separately? C. Group insurance is always more expensive than individual insurance? Or D. Individual insurance covers more people than group insurance? The answer is B. Individual insurance evaluates each applicant separately. Group insurance underwriting typically assesses the risk of the entire group, while individual insurance underwriting evaluates each applicant's health and risk factors separately. Which of the following is not a tax advantage of group health insurance? Is it A. Employer-paid premiums are tax deductible? B. Employee contributions can be pre-tax? C. Individual policy premiums are tax deductible? Or D. Group premiums reduce taxable income? The answer is C. Individual policy premiums are tax deductible. Why this question may seem a bit tricky. The use of not can easily be overlooked, leading to incorrect answers. Group health insurance premiums paid by employers are tax deductible, and employee contributions can be pre-tax, but individual policy premiums are not a group benefit. A small business owner is deciding between offering group health insurance or letting employees purchase individual plans. What is a primary benefit of choosing group insurance? Is it A. Coverage without individual health assessments? B. Lower premiums for all employees? C. More comprehensive coverage options? Or D. Tax-free benefits for employees? The answer is A. Coverage without individual health assessments. Group insurance often provides coverage without individual health assessments, making it easier for employees to obtain insurance regardless of pre-existing conditions. How are premiums for individual health insurance typically determined? Is it A. Based on the employer's risk profile? B. Determined by the number of dependents? C. Set by government regulations? Or D. Based on age and health status? The answer is D. Based on age and health status. Individual health insurance premiums are based on the applicant's age health status, and other personal risk factors. An employee is considering whether to enroll in their company's group health plan or purchase an individual policy. What is a potential tax benefit of choosing the group plan? Is it A, higher deductible options, B, premiums paid with pre-tax dollars, C, employer contributions are tax-free, or D, more flexible spending accounts? The answer is B, premiums paid with pre-tax dollars. Group health plan premiums can often be paid with pre-tax dollars, reducing the employee's taxable income. What is a primary characteristic of group health insurance underwriting? Is it A, each member is individually assessed, B, the risk is assessed for the entire group, C, premiums are based on individual health status, or D, only healthy individuals are accepted? The answer is B, the risk is assessed for the entire group. Group health insurance underwriting typically involves assessing the risk of the entire group rather than individual members, which can lead to more favorable terms for members with pre-existing conditions. High difficulty topics and ethics. State-specific regulation and ethical scenarios. Which state-specific regulation requires insurance agents to complete continuing education courses every 2 years? Is it A, mandatory ethics training, B, continuing education requirement, C, annual license renewal, or D, professional development program? The answer is B, continuing education requirement. Many states mandate that insurance agents complete continuing education to maintain their licenses. This ensures agents stay informed about industry changes and ethical practices. Which of the following is not typically required by state regulations for insurance agents? Is it A, licensing examination, B, continuing education, C, college degree, or D, ethical training? The answer is C, college degree. Why this question may seem a bit tricky, the phrasing "not typically required" can lead to confusion. State regulations often require licensing, continuing education, and ethical training, but not necessarily a college degree. An insurance agent in California is approached by a client who wants to invest in a policy that promises guaranteed returns. What should the agent consider regarding state-specific regulations before proceeding? Is it A, verify compliance with state regulations on guarantees, B, proceed without checking as guarantees are standard, C, consult a financial advisor for investment advice, or D, offer the policy if it meets the client's needs? The answer is A, verify compliance with state regulations on guarantees. Agents must ensure that any guarantees are compliant with state regulations and not misleading. California has strict rules about how guarantees can be presented to clients. What is the primary purpose of state-specific ethical guidelines for insurance agents? Is it A, to increase sales quotas, B, to simplify policy language, C, to reduce competition, or D, to protect consumer interests? The answer is D, to protect consumer interests. State-specific ethical guidelines aim to protect consumers by ensuring that agents act with integrity and professionalism, maintaining trust in the insurance industry. A New York insurance agent is reviewing a policy with a client who is concerned about privacy. What should the agent explain regarding state-specific privacy regulations? Is it A, privacy regulations are less strict than federal laws, B, client information is protected and disclosure is required, C, clients have no control over their data, or D, privacy concerns are addressed at the federal level only? The answer is B, client information is protected and disclosure is required. New York has stringent privacy regulations that require agents to protect client information and disclose how it will be used. This ensures clients are informed and their data is secure. Which state-specific regulation mandates that insurance agents disclose all fees and commissions to their clients? Is it A, Privacy Protection Act, B, Consumer Transparency Act, C, Agent Licensing Act, or D, Insurance Fair Practices Act? The answer is B, Consumer Transparency Act. Many states require insurance agents to disclose all fees and commissions to ensure transparency and protect consumer interests. This regulation helps clients make informed decisions. Complex product scenarios, for example, MECs, variable life. What is the primary characteristic of a modified endowment contract? Is it A, it offers tax-free death benefits, B, it allows unlimited contributions, C, it is subject to LIFO taxation on withdrawals, or D, it provides guaranteed cash value growth? The answer is C, it is subject to LIFO taxation on withdrawals. A modified endowment contract is primarily characterized by its tax treatment, where distributions are taxed as income first and may incur a penalty if taken before age 59 and a half. Which of the following is not a feature of variable life insurance policies? Is it A, flexible premium payments, B, guaranteed cash value growth, C, investment options, or D, death benefit protection? The answer is B, guaranteed cash value growth. Why this question may seem a bit tricky, the use of "not" requires careful reading. Variable life insurance policies do not guarantee cash value growth, as it depends on investment performance. A client wants to withdraw funds from their MEC before age 59 and a half. What tax implications should they expect? Is it A, income tax and a 10% penalty, B, only income tax, C, no tax implications, or D, capital gains tax? The answer is A, income tax at a 10% penalty. Withdrawals from a MEC before age 59 and a half are subject to income tax on the gain and a 10% penalty, similar to early withdrawals from retirement accounts. Which statement about MECs is always true? Is it A, they never provide tax-free loans, B, they always have flexible premiums, C, they are never subject to penalties, or D, distributions are taxed as income first? The answer is D, distributions are taxed as income first. Why this question may seem a bit tricky, the use of always can mislead. MECs always have distributions taxed as income first, but other features may vary. A policyholder with a variable life insurance policy wants to switch investment options. What should they consider? Is it A, there are no fees involved, B, it may affect cash value and death benefit, C, it guarantees higher returns, or D, it is only allowed once a year? The answer is B, it may affect cash value and death benefit. Switching investment options in a variable life policy may involve fees and affect the policy's cash value and death benefit, depending on market performance. What is a key feature of a variable life insurance policy? Is it A, guaranteed cash value, B, investment flexibility, C, fixed death benefit, or D, fixed premium payments? The answer is B, investment flexibility. Variable life insurance policies allow policyholders to allocate a portion of their premium payments to a separate account, which can be invested in various instruments like stocks and bonds. Insurance regulation and licensing. licensing requirements, and producer responsibilities. What is the minimum age requirement to obtain an insurance producer license in most states? Is it A, 16 years old, B, 18 years old, C, 21 years old, or D, 25 years old? The answer is B, 18 years old. Most states require individuals to be at least 18 years old to apply for an insurance producer license. This is a standard requirement across the United States to ensure maturity and legal responsibility. Which of the following is not typically required to maintain an active insurance producer license? Is it A, continuing education, B, renewal fees, C, maintaining a personal website, or D, adhering to ethical standards? The answer is C, maintaining a personal website. Why this question may seem a bit tricky, the phrasing "not typically required" can lead to confusion. Continuing education is required, but a personal website is not. The other options are standard requirements. As an insurance producer, you discover that your license has expired. What is the first step you should take to rectify this situation? Is it A, stop all insurance activities immediately, B, continue working while applying for renewal, C, notify your clients about the expiration, or D, wait for the renewal notice from the state? The answer is A, stop all insurance activities immediately. The first step is to cease all insurance activities immediately, as operating with an expired license is illegal. Then, you should contact the licensing authority to understand the renewal process. What is the primary responsibility of an insurance producer? Is it A, selling and servicing insurance policies, B, underwriting insurance policies, C, adjusting insurance claims, or D, auditing insurance companies? The answer is A, selling and servicing insurance policies. The primary responsibility of an insurance producer is to sell and service insurance policies. This involves understanding client needs and providing appropriate insurance solutions. You are an insurance producer who has just moved to a new state. What must you do to continue practicing legally? Is it A, continue using your current license, B, notify your clients of the move, C, take a break until you decide your next steps, or D, apply for a non-resident license or transfer your license? The answer is D, apply for a non-resident license or transfer your license. To practice legally in a new state, you must apply for a non-resident license or transfer your existing license, depending on the state's requirements. What is the typical duration of an insurance producer's license before it needs renewal? Is it A, 1 year, B, 3 years, C, 2 years, or D, 5 years? The answer is C, 2 years. Most states require insurance producer licenses to be renewed every 2 years. This ensures that producers stay updated with current laws and practices.
Stuck on a question? Just think of the Birdsy link in the description as your friendly neighborhood superhero, swooping in to save the day with answers. Feel free to explore it now and return to continue. Simply hit pause, and we'll be waiting when you get back.
State and federal regulatory frameworks. Which federal agency is primarily responsible for regulating the insurance industry in the United States? Is it A, Securities and Exchange Commission, B, Federal Reserve, C, Federal Insurance Office, or D, Department of Commerce? The answer is C, Federal Insurance Office. The Federal Insurance Office is the main federal agency overseeing insurance regulation, although states primarily regulate insurance. The FIO monitors the insurance industry and advises on national policy. Which of the following is not a function of state insurance departments? Is it A, licensing insurance agents, B, setting federal insurance policies, C, approving insurance rates, or D, conducting market conduct examinations? The answer is B, setting federal insurance policies. Why this question may seem a bit tricky, the wording "not a function" requires careful reading. State insurance departments do not set federal insurance policies, they regulate within their state. An insurance agent in California is found guilty of fraud. What action can the state insurance department take? Is it A, revoke the agent's license, B, impose federal penalties, C, transfer the case to the SEC, or D, issue a warning letter? The answer is A, revoke the agent's license. The state insurance department can revoke the agent's license as a disciplinary action for fraudulent activities, ensuring consumer protection and maintaining industry standards. Which of the following statements about the McCarran-Ferguson Act is false? Is it A, it gives states the authority to regulate insurance, B, it exempts insurance from federal antitrust laws, C, it was enacted in 1945, or D, it grants federal regulation precedence over state regulation? The answer is D, it grants federal regulation precedence over state regulation. Why this question may seem a bit tricky. The question asks for a false statement, which can be easily overlooked. The Act does not grant federal regulation precedence over state regulation. A new insurance company wants to operate in multiple states. What must they do to comply with state regulations? Is it A, register with the Federal Insurance Office, B, obtain a single federal license, C, obtain a license in each state, or D, submit a national application to the NAIC? The answer is C, obtain a license in each state. The company must obtain a license in each state they wish to operate, as insurance is regulated at the state level, requiring compliance with each state's specific regulations. Which of the following is a primary function of state insurance departments? Is it A, licensing insurance companies and agents, B, regulating federal insurance programs, C, setting national insurance rates, or D, providing insurance to state employees? The answer is A, licensing insurance companies and agents. State insurance departments are responsible for licensing insurance companies and agents, ensuring compliance with state laws, and protecting consumers. They do not regulate federal insurance programs. Unfair trade practices and ethics. What is considered an unfair trade practice in insurance? Is it A, offering discounts, B, misrepresentation, C, prompt claim settlement, or D, providing policyholder dividends? The answer is B, misrepresentation. Misrepresentation involves providing false or misleading information about a policy, which is considered an unfair trade practice. It can lead to penalties and loss of license for the insurer. Which of the following is not considered an unfair trade practice in insurance? Is it A, rebating, B, twisting, C, offering coverage, or D, false advertising? The answer is C, offering coverage. Why this question may seem a bit tricky, the use of not can mislead. Rebating is often misunderstood, but is indeed an unfair practice. Offering coverage is a standard practice. An insurance agent offers a client a portion of their commission to secure a policy sale. What ethical issue does this scenario illustrate? Is it A, rebating, B, churning, C, misrepresentation, or D, coercion? The answer is A, rebating. This scenario illustrates rebating, which is an unethical practice where an agent offers part of their commission to entice a client to buy a policy. Which practice involves persuading a policyholder to replace their existing policy with a new one to their detriment? Is it A, rebating, B, coercion, C, misrepresentation, or D, twisting? The answer is D, twisting. Twisting is the practice of persuading a policyholder to replace their existing policy with a new one, often to the policyholder's detriment. A client is convinced by an agent to switch their life insurance policy with promises of better returns, but the new policy has higher fees. What unethical practice does this represent? Is it A, rebating, B, misrepresentation, C, twisting, or D, churning? The answer is C, twisting. This scenario represents twisting, where an agent persuades a client to switch policies under false pretenses, often leading to higher costs for the client. Which of the following is considered an unfair trade practice in insurance? Is it A, B, misrepresentation, C, providing customer service, or D, advertising? The answer is B, misrepresentation. Misrepresentation is an unfair trade practice where false or misleading information is provided to a policyholder. This can lead to incorrect decisions by the consumer and is prohibited by insurance regulations.
Thanks for joining us today. If you found this video helpful, subscribe to our channel for more practice exams, tips, and tricks. And don't forget to visit Birdsy.ai for complimentary study sessions with Birdsy, your AI-powered study partner.